The Commerce Department today released advanced retail sales for October. They were up 0.4% versus September. That is, of course, the seasonally finagled number. That beat consensus expectations of a 0.1% increase. Let's take a look at the actual data and see how it stacks up. Now, this is a busy chart, but don't be intimidated. There's a couple of simple storylines here, and they're important. I've shown three separate graphs, each with a couple of lines on them. This chart shows the nominal retail sales, not seasonally adjusted, going back to 2002, along with a month-to-month trend line and the S&P 500. The middle chart shows real retail sales excluding gasoline sales. This is retail sales adjusted for inflation and excluding gasoline, along with a month-to-month trend line, and the Fed's system open market account, again going back to 2002. The Fed data started in late 2002. And the bottom chart shows the annual rate of change, the percentage change from 5% to minus 10%, of this graph up here, the real retail sales ex gasoline. Now, when you look at the nominal retail sales, not seasonally adjusted, we are able to see not only the seasonal pattern, but the trend pattern. It's been very stable and rather impressive. And you can also see that the turn in retail sales was more or less concurrent with the turn in the stock market. And the stock market was more or less concurrent with the Fed beginning to print money under QE1. Now, I just want to go back to 2007 here where the market topped out. Look what happened. The Fed was growing its system open market account steadily for 5 years at a 5% annual growth rate. Then in 2007, when the shit started to hit the fan and the wheels started to fall off, the Fed began to panic and began all its alphabet soup programs. And then initially, to fund the alphabet soup programs, the Fed decided that it was going to take the money out of its system open market account. That basically starved out the primary dealers and triggered the collapse in stock prices, which helped to trigger the collapse in the economy. Now, everything was going down anyway because the housing market was starting to collapse. But this exacerbated the situation and it turned it into a panic in 2008. And the economy weakened pretty severely over that time. The Fed realized its mistake in 2009, started QE1, stocks reversed, the economy began to find its footing, and since the middle of 2009, it's been growing at a fairly stable rate, including about a 2% annualized CPI increase. Now, we know that doesn't state all of inflation, but for the purposes of this analysis, that's how I adjusted the nominal retail sales to get to the real retail sales. And again, I excluded gasoline because that tends to skew things in the opposite direction. When gas prices rise 50% in a year, it makes it look like retail sales are going up, when in fact that rise in gasoline prices acts like a tax and pulls money out of consumers' pockets, and they spend less on retail. And it works in the opposite direction when gas prices are falling. So I like to take that out of the equation and just look at retail sales ex-gasoline and adjusted for inflation. And again, we've had a fairly steady trend, although nowhere near as impressive as this uptrend. Just in the last couple of months, if you follow this pink line here, which is the October year-to-year change, you can see the trend has accelerated a little bit and just recently has surpassed the 2007 peak. Now consider this, real retail sales are just a couple of percent higher now, not even a full percent higher than they were in 2007, considering the fact that U.S. population grows at 1% per year. The population of the United States is now 7% higher than it was in 2007, but retail sales are only about 1% higher. Finally, if you look at the annual growth rate, you can see that since the middle of 2011, or actually going back to 2010, it has fluctuated between 2.5% and 5% growth, averaging on an annual basis somewhere around somewhere between 2.5 and 3.5%. Pretty much it fluctuates back and forth, just a sort of a gentle undulation in that range. That's in spite of the fact that the Fed has been stop and go on QE. QE1 was more or less concurrent with the rebound in the economy. Then the Fed paused and economic growth slowed down. Look, you're not going to have that kind of breakneck pace forever, as we saw here. But then when the Fed started QE2 because they thought growth was too slow, look what happened. Nothing. The growth rate remained stable. Then the Fed halted QE2 in the middle of 2011, and they paused until the end of 2012, the fourth quarter of 2012, deciding again that the growth rate was too slow. Even though nothing had changed, it was pretty much the same, around 3% growth on a real basis, right here. So, why the panic? Well, ultimately, the Fed decides in September of 2012 it's time for QE3. They think that's going to boost the economy. And that swings into action with the first MBS settlements in November, right here, and November here. And then they added the Treasury settlements here in January, and it's off to the races for QE4. But what happened to retail sales? Nothing. The growth rate remained stable between 2.5 and 3.5%. So QE 3 and 4 has had no impact on the economy, but it's done a heck of a job in getting a bubble going in the stock market. So the question is, what the heck is the Fed doing with this quantitative easing? Why is it really doing it when it knows, it can see very clearly that it's had no impact on the economy? The answer lies elsewhere, and we'll get into that in another video. Meanwhile, I hope you find this one instructive, and I'm going to post this chart at wallstreetexaminer.com so that you can study it a little more closely at your leisure. If you'd like to learn more about how the Fed rigs the market and attempts to rig the economy and fails, visit me at wallstreetexaminer.com. That's where I do my proprietary research in the Wall Street Examiner Professional Edition on the Fed and the world central banks, the U.S. Treasury, and the forces of macro liquidity that drive markets. That's wallstreetexaminer.com, the professional edition. You can try it risk-free for 30 days. Get the facts.